The world of investing is a confusing and overwhelming place. Just getting started has proven to be a feat only the best of us can overcome. It is a fast-moving, unpredictable, cutthroat world where you have to stay on top of your game to be able to come out ahead. Luckily, I've compiled my top 5 stock investing tips so that you can all traverse this world without having to worry. The first tip is to make a goal. It may sound a bit cliche, but it holds a lot of importance in the realm of investing. It makes up your whole investing strategy, and it can be your guiding factor when you're trying to make decisions. You should also use the steal structure when coming up with your goal, as this will help further guide you along the way through your investing journey. And although you don't have to follow the structure attentively, you should still keep it in mind when coming up with your goal, because it will help give you a good thing to work towards. Let's break this down. So the SMART acronym stands for specific, measurable, achievable, realistic, and time-based. And let's say you want to invest $10,000 by the end of 2023, starting from 2024. So that is just a normal goal, and it already has some of the SMART attributes in it, but we can make it better. It's already very measurable because checking the value of a stock is just as simple as a refresh. It's also time-based because you've said that you want to do it in a 6-year period. You could be more specific though, so maybe talking about what types of shares you want to invest into, and you could also talk about the growth of the shares instead of just the value, because after the 6 years you might just have $10,000 worth of value in the shares just because that's how much you've spent buying them in the first place. For the last two, realistic and achievable, you would have to assess your current situation. How much money do you have lying around, and how much disposable income are you making? Disposable income is all of the income that you're making after you take off all of the expenses and taxes that you would have to pay. And this might mean that you're able to invest $150 per month. But after the 6 years, you would have already invested your $10,000 and an extra $800. This would mean that you may have to change what your goal is because it wouldn't be that much of a challenge to achieve. You could either do this by reducing the time frame, increasing the end goal amount, or just keeping some of the money for yourself and investing, let's say, $125 each month. The second tip is to harness what's called dollar cost averaging, where you invest regularly, let's say every 3 months. So let's say that would mean you would invest $400 every 3 months. The benefit to this is that it's spreading out your input into the market, some being where the market's lower than your average purchase price and somewhere it may be higher. This strategy will reduce how much you lose if a share goes down in value, because you're taking the opportunity to buy more and benefit when it returns to its original price. And you can also use this strategy, along with the freedom of being able to choose whatever shares that you want to invest into, to invest more into certain shares and less into others to even out their impact on your portfolio. Another positive aspect of this strategy is that it reduces the amount of time that you have money just sitting in your bank account and actually losing value. But you don't want to invest too often though, because most banks will charge you a transaction fee when you either buy or sell shares. So you want to make sure that that fee will only be a small percentage of the amount of money that you're investing through that transaction. The third tip is to subscribe. I'm only joking, it is diversification, making sure that you're investing into different industry types, share types, and overall risk. And the main determiner of your investing strategy will be your current financial situation. This diversification helps you in many ways, one of which is that your portfolio's value is a little bit safeguarded, because if one specific industry goes down in value due to a certain event, it won't affect the whole portfolio. It also extends to a micro level, because if one company gets a bit of bad publicity, its share value may go down in value because lots of people want to try and sell their shares. Diversifying your risk is also of large importance, because you may feel like you want to support those up-and-coming companies that are a lot more volatile than the overall market, but you'd also put some apples into the basket of more stable companies that won't lose a quarter of their value in a single week. A good way to invest into stable dividend-paying stocks is to invest into ETFs. These exchange-traded funds are a curation of lots of different companies put into a weighted basket. This is done by a different company who would buy shares in each of these top different companies within a certain industry and provide investors an option to buy a small section of that collection. And another good thing that they do is they're very involved, so they will change the amount of each company that they have within that selection based on the current changes in the market. When you're starting out investing, you can generally be more curious and willing to take risks. This is because you won't have as much money on the line, and you're probably using a bit of your disposable income to dip your feet through the portal into this investing world. The penultimate tip is to be bold. If you want to survive in this cutthroat world of investing, you have to know when to cut your losses or winnings and move on. As I've said in many videos, and I'll say it again, we cannot see the future, and trying to base your decisions based on something you think might happen is not the best way to move forward. And just because something has fallen 20%, it doesn't mean that it will suddenly flip and come right back up to its prior value. It also doesn't mean that if something's already risen 20%, it'll just continue rising. Obviously, your decisions should also be based on articles and other news that you hear about the company, because you don't want to miss out on an extra 10% of growth, but you also don't want to be indecisive and take too long figuring out that the share isn't working out and therefore losing another 10% of value. Overall, missing out on a little bit of extra growth will be cancelled out by the times where you save yourself from extra losses. And you should remember that if you're diversifying your portfolio, then missing out on a little bit of growth 1 month isn't that bad, because you're just looking for an overall increase in your portfolio's value. The last tip, if you don't include my cheeky one after this, is to stay true to your roots. Investing can be very confrontational and confusing to make decisions. We also don't all have lots of time in our busy lives to go and research lots of different companies to figure out what we should be investing into. How you can improve your overall performance is to invest into the companies that you already know a lot about. This could be as simple as the car that you drive or the tech company that you're interested in. This helps inform your decisions because you already know quite a lot about what the company is doing, what projects they're undertaking, how that would affect their image, and how that would subsequently affect their stock price. You can also look to invest into companies that are trying to make a difference in a subject area that you're interested in or passionate about. Some current topical examples include companies that are striving to go completely carbon neutral, or companies that are striving to have a upper management team that's diverse in terms of gender, ethnicity, and beliefs, or even just companies that are pledging to send some of their profits towards humanitarian efforts, such as the rehabilitation of Ukraine. My last cheeky extra tip is to keep the capital gains tax in your mind. I've made a full video that goes into quite a lot of depth, but the short explanation is that when you have an investment and if it goes up in value, when you sell it, you have to add that growth in value, the difference between the purchase price and the selling price, to your taxable income. And what you can take advantage of is the rule that if you hold the investment for over 12 months, you get to halve this value before you add it onto the total income that your tax is calculated off of. This would be a bit harder to achieve if you're playing on the riskier side and are buying and selling shares regularly. But if you're in the game for the long run and are buying more stable companies, you can use this benefit as a natural pause button, telling you to slow down and make more informed decisions, just worrying about the yearly average returns, not just the day-to-day variances. That's all for me today. I've been Tom, and I'm signing off on yet another Tom's Winning Magic video. See ya!